The last year was a hard year for stonks. Are you confused when it comes to monetary policy or what the fuck central banks are doing? Don't worry, I got you covered. I can confuse you even more. Let's get into it. Welcome to the Toaster Botnet, where I babble about random things until you either get bored or hit the subscribe button. This week's topic: central banks. First things first, the current situation. God, we're all gonna die. Abandon ship, sell everything, flee, you fools. Nah, just kidding. Here's what's going on. Central banks manage the currency and monetary policy of countries. In America, that would be the Fed, the Federal Reserve Bank, and in Europe, it would be the EZB, Europäische Zentralbank, European Central Bank. And in the last years, central banks were printing money like mad. We had a long bull run in the markets, going as far back as 2008 financial crisis. And especially in the last few years during COVID, money printing went off the charts. I'm too lazy to look up exact numbers, but it was something in the trillions or something. And as you all know, the money printer has stopped last year. Inflation is going crazy. We are in a bear market right now, and everybody's losing it and calling for even lower prices. Bobo the bear is going wild right now. The US is in the middle of a recession, and Europe is heading into one as we speak. If this sounds a bit like financial jargon to you, don't worry, I'll get into it. I want to talk a bit about how central banks influence interest rates and inflation, and give you a bit of the basics of how money works. Let's start this video with things like interest rates, inflation, quantitative easing, quantitative tightening, and maybe you will get an idea of the current situation. So what is inflation? Well, inflation means that prices of goods are increasing, and with that, money becomes worth less. Like when your loaf of bread costs $1 million in the extreme case. Central banks try to steer markets to regulate inflation and want to keep it at about 2%. Well, why 2%? Because if we have no inflation at all, money is more worth in the future than it is today, and everybody just starts hoarding it and doesn't spend it. The economy slows down, comes to a halt, and everybody's just hoarding money. So central banks want to avoid that. Well, you get the gist of it. A little bit of inflation is actually a good thing. But in the recent years, inflation has gone up a teensy tiny bit. At least here in Germany, there are times where it was around 10% nearly, which is bad. So will we now suffer the consequences of all the money printing that happened in the last few years? Let's talk about what central banks have done and what they are currently doing to combat the situation. First off, what is the federal funds rate? That's an important metric. Well, basically, central banks loan money to other banks, and these banks give out loans to businesses or people. And when the federal funds rate, which is the rate at which the central banks charge interest for the banks, if that increases, so do the loans for businesses and people. Here in Germany, the phrase Leitzins might sound familiar. For a long time, we had a zero interest rate environment here in Europe, which means money was cheap and people were getting loans with very low interest rates. But over the last year, funds rates were increased to combat inflation. If loans are expensive and you get more interest for hoarding money, people will consume less. The economy slows down or cools off, and people won't spend as much. If this happens, so in theory, goods and prices, so the prices of goods will stabilize over time because, well, of simple supply and demand. The current rate of the Leitzins here in Europe is about 2.5% and is about to increase probably in the next coming year. This is bad news for countries like Spain or Italy with high government debt because they may not be able to pay their interest anymore. But that goes beyond the scope of this video. But there are other ways to control monetary policy. The most important ones are probably quantitative easing and quantitative tightening. Quantitative easing was used by a lot of countries since the last financial crisis to recover from their respective recessions, and it kept on going in the last couple of years. It's basically like printing money. This is what people mean when they say Papa Powell makes the printers go brrr. Not that it's actually like printing paper money, but more like central banks are creating digital money for themselves. Then they use this money to buy assets in the market. Most of the time they buy government bonds. This in turn increases the money supply in the economy. Because if they buy up assets in the market, more money comes in the market and it gets distributed, and with this the money supply basically increases. Through injecting this money, central banks hope to lower interest rates and increase lending. Of course, there's more to it. It's a bit more nuanced than that, but let's keep it simple. For the sake of simplicity, let's just say printers go prrr. And with printing money, there comes inflation. And with all things, if there's more of the thing will get cheaper, and the same goes for money. And since mid-2021, roundabout, we have an inflation surge. Quantitative easing has stopped to combat inflation. And this is the current situation now. And now that we know what the central banks have done, let's see what they do now. They need to step on the brakes. They need to counteract all the money printing and the inflation. And now quantitative tightening comes into play. Quantitative tightening, as the name suggests, is basically just reverse quantitative easing. Now the central banks take all the assets, bonds, government bonds, whatever assets they bought earlier, and they are offloading them into the market and are trying to sell them. When they sell them, the money they get for that will be basically destroyed and deleted. Through this measure, basically money is taken out of the economy, and we get an effect of hitting on the brakes. This, in theory, should cool down everything and combat the high inflation rate. And now to the interesting part. What does this mean for investors? What happens when the interest rates go up? We're all doomed. Doomed! Nah, just kidding. Well, if the federal fund rate goes up, so go rates for mortgages, loans and bonds. Higher interest rates also means higher rates for businesses, which means companies make less profits because they need to pay more for loans, and the stocks might go down. Also because bonds offer higher rates than the stock market, eventually investors might choose bonds over stocks, which might also bring stocks down. So what to do in this environment? Well, it's probably all priced in anyway, as always. So now it's probably too late. And if it isn't, investing according to current market sentiment only makes sense for short-term investors. If you are in stocks long-term and have a time horizon of 10, 15 or 20 years or more, so basically retirement savings, the best strategy is just to keep buying during these times because prices are lower. Granted, they could go even lower and the recession may get even worse, but you can't time the bottom. No one ever times the bottom. It's pure luck. So averaging into the market makes the most sense. Hashtag not financial advice. So, thank you for watching. And as always, I hope you got some value out of this video. Like, and see you next time on the Tickety Toaster Botnet.